I want to particularly welcome everyone who is dialed into this conference remotely. We have an enormous audience, multiples of the audience that we've had in past years. So we're thrilled with the broad interest, and the audience from looking at the participants is all around the world. I particularly also want to thank the Kansas City Fed. We at the Dallas Fed have really enjoyed our partnership with Kansas City and hope to continue this for many years to come. So I'm just going to make a few comments and brief comments about the U.S. economy, and I'm going to make three comments about energy. Then I'm going to turn it over to Mark Wynn, and we're going to have a conversation for the remainder of the time. But let me just start with a thumbnail sketch on what's been going on in the U.S. economy. As you all know too well, we had a severe contraction in the second quarter of 2020. The U.S. economy contracted at an annualized rate of about 32% in the second quarter. As severe as that contraction was, we think the U.S. economy bottomed out in April. So this is very brief, short contraction, but severe, and started to recover in May and in June, and has been recovering ever since. So that third quarter GDP growth rebounded on an annualized rate of about 32 or 33%. So we had a 32% annualized decline, a rebound of about 32, 33%. And as we sit here today, it's our belief at the Dallas Fed we're still growing in the U.S. economy, but this growth is probably stalling. It's decelerating. And the reason it's decelerating is primarily due to a resurgence in COVID-19 around the country. Having said that, what we also notice, and we track at the Dallas Fed mobility and engagement by county and state throughout the country, what we've noticed is even with the resurgence, mobility and engagement is dramatically higher than it was in the spring. And people are learning and have adapted their daily routines to still be engaged, much more than they were in the past, despite the resurgence. Having said that, what we also are starting to see is in cities and states where the resurgence gets severe enough. What would an example be? El Paso, Texas. We're starting to see mobility engagement fall off or severely deteriorate because it's necessary for local officials, even though they don't want to impose new restrictions, they feel compelled to impose new restrictions. Unfortunately, given the direction of the resurgence, every week that goes by, we're observing more and more cities in the United States start to see deteriorating mobility engagement due to more restrictions. Denver, Chicago would be examples, parts of Utah, and we're seeing Wisconsin would be another example. And so our concern is as mobility and engagement deteriorates, that has the effect of slowing growth. And so we're watching very carefully, but it's our view that the last part of the fourth quarter and certainly the first quarter are going to be very challenging in the United States, and growth is going to be, and the rebound is going to be decelerating and much more muted. I guess the good news is, due to prospects for a vaccine, it's also our view that as we get into 2021, we're going to see GDP growth at or greater than 3.5%. So well above trend growth. The issue is it's going to be back-end loaded in probably the second half of next year. It's our hope in our base case that if a vaccine is approved by the FDA during 2020, first thing that will happen is healthcare workers will get immunized. That will take some time, and that by sometime by March, let's say, you're going to start to have beginning broad dissemination an availability of the vaccine, but it will take a good part of 2021. And so we're going to have to be living with mask wearing and social distancing for a good part of next year. But even with that, we think 2021 is going to be a very good year for GDP growth. The challenge will be getting through the next 3 to 6 months and weathering this resurgence. Okay, so let me make a few other comments, and then I'm going to say a couple of things about energy. There are 2 or 3 things that are very unusual about and worth noting about what we've been going through over the last 9 months. Number one, normally when you have a severe contraction like we did in the second quarter, you would see household income drop and you would see consumer spending drop. We did not see that during this pandemic. Household income has stayed relatively solid and consumer spending has stayed solid. The big reason for that, in our judgment, is the fiscal relief, particularly unemployment benefits. And so what has that meant? It's meant that while people are not spending on restaurants and airlines and hotels and certain types of leisure and entertainment, the economy has not lost that GDP. The GDP has shifted to other segments, home improvement, home prices. A number of other sectors of the economy are seeing very good business. And so that's one aspect that's very unusual. But one of the things we also observe, if you're a small business in a person-to-person contact industry, this still feels pretty bad to you. And while business may have gotten better, you clearly feel that your business is very depressed. If, on the other hand, you're at a business where technology allows you to work remotely, and that's a broad range of businesses, or you're able to use technology to serve your customers, even though you've had to adapt, you're actually seeing maybe business has been pretty solid, and your expenses, because you're not traveling and other things, may actually be down, and you might be having a good year. So we see a real divergence that we normally don't see in a downturn. The second thing I'd mention is this pandemic has affected people differently based on their educational attainment. If you've got a college education or greater, it's much more likely that you work in a job that you can work successfully remotely. And you're much less likely to have lost your job, and you're much less likely to have lost income. If, on the other hand, you're a person that has a high school education or less, it is far more likely that you work in a person-to-person contact industry. It's less likely that you've been able to find a way to work remotely. It may just not be possible. You're more likely, therefore, to have lost your job and lost income. And you're making ends meet right now based on fiscal stimulus and unemployment benefits. And because those benefits, at least portions of them, are expiring, you're right now making ends meet based on savings. And our analysis is that savings is beginning to run out. Also, if you're a woman with a high school education or less, and you have a child, you are far more likely than your male counterpart to have left the workforce. So during the Great Recession, as challenging as it was, we did not see this divergence between the experience of men and women. We are seeing it during the COVID pandemic. And a lot of this has to do with a lack of availability of childcare and other issues, but we're seeing women disproportionately leaving the workforce. And it's unfortunate because going into the pandemic, before the pandemic, one of the biggest gainers in terms of share of the workforce was women with a high school education or less. So I guess the point of all this is we're going to have a lot of work to do coming out of this pandemic to help get people with high school educations and less back into the workforce. And the reason this may be challenging is they may not have a job to go back to because the business they worked at may not, and the job they had may not exist. And so job retraining, making sure we've got good availability of daycare, particularly for women at lower incomes who have children, it's going to be critical. And it's going to be very important to economic growth that we find ways to get these groups back into the workforce and do it as quickly as we can. Okay, so let me then turn to talk a bit about energy, and then I'm going to throw it back to Mark. As the people in this audience know too well, we've had a supply shock and a demand shock back in March and in the spring of this year. Obviously, COVID meant people are driving much less. And oh, by the way, driving activity declined significantly. We're still only in the United States, by our estimate at the Dallas Fed, about 88% of where we were a year ago in terms of driving activity. We are not nearly back to normal yet. I'll come back to that. And in addition, because of Saudi Arabia making the decision to increase production because of inability to come to an agreement with OPEC and Russia, we had a supply shock. The long and the short of it is, because of that glut of inventory that's been created, it's our own estimate at the Dallas Fed, and based on our analysis and discussion with contacts, many in this audience, that it won't be until early 2022, first half of 2022, before we work off globally this excess inventory. Now, one of the things that's going on, obviously oil is a global commodity. Many parts of the world are seeing much closer return of energy usage. China, Japan, Taiwan, South Korea are closer to quote unquote normal. The other big issue that we're seeing is, while driving activity is 88%, flying activity, as you all know, is dramatically down, and jet fuel has been a big part of the energy complex. With all that said, it's our own estimate at the Dallas Fed that U.S. production will decline this year from about 12.8 million barrels a day, which is where we were in January, and we will end the year at closer to 10.5 and 10.75 million barrels a day. So a significant decline, and it's our best judgment that energy production in the United States will then stay flat through 2021. So what's happened as a result of these changes is we've seen substantial job loss, bankruptcies, restructurings, and the other thing we're seeing is significant consolidation. So our own view is there'll be a healthy energy industry and oil and gas industry, and I'll come to other parts of energy in a moment, but there'll be a healthy oil and gas industry for years to come, but it will be more consolidated. Participants will have more scale, and they're going to need to be able to find ways to lower their costs. And scale is critical to that. Technology will be critical to that, so they can operate potentially in a lower for longer price environment and adapt to a number of the environmental restrictions in terms of sequestration and other activities, so that they can produce more efficiently. While that's going on, we think there will be substantial growth and opportunity in wind, solar, battery technology, and a whole range of other innovative ways to create other forms of energy. And we think there will be aggressive growth in a number of those areas. They will create, by the way, substantial amount of jobs. There'll be substantial commercial opportunities. And so when we look out ahead over the next few decades, we believe there will be a significant and important need for still fossil fuels, but it will be a smaller percentage of total energy consumption, not just in the United States, but globally, but it will still be vital. And there will be substantial growth and substantial business opportunity and a whole range of other alternatives. And I know that's one of the subjects you'll be talking about in panels later this morning and during today. So with that overview, let me just stop and turn it back to Mark.
Great, thank you, Rob. And just a reminder to the audience that if you want to submit a live question, just you can do so through the Q&A button at the bottom of the screen. So the first question we have is from Beverly Barrett at the University of St. Thomas in Houston. And her question is, what role will automation have in shaping the energy industry and manufacturing more generally as it competes with labor over time? Will automation be competitive or complementary to productivity and economic growth?
So industry-wide and globally, one of the things that's coming out of this pandemic, we had a trend of technology and technology-enabled disruption. And Mark Wynn knows this well. We've hosted 2 conferences on this subject. We've got another one coming up later this year or next year. But we think this trend, because of the pandemic, has accelerated, and companies are much more aggressively looking for ways to use technology to replace people. Doesn't mean there won't be jobs. There'll be plenty of jobs, but the nature of jobs will likely change and will require a different type of training and background. In terms of the energy business, we spend a lot of time with energy contacts who talk to us about a number of ways to use technology to either operate wells with fewer people, operate wells more remotely, operate them more efficiently, to do analysis of energy resources. And so we think you're going to see extensive use of technology. And also, technology is going to be critical in a lot of these environmental processes like sequestration. And so we think that's another reason why, again, you're seeing more need for size, scale. You're seeing a lot of consolidation we're seeing to be able to afford this. But there'll still be jobs, but the mix will change and the mix of industries will change. And I would say this will be capitalism at work. But a lot of people ask me, will there be enough jobs? I think there'll be plenty of jobs. It's just the mix will change and the training for those jobs will change, which is why skills training, I think, will become dramatically more important, and we need to beef it up in the United States to adapt to these trends.
Good. Next question is from Matthew Munster at Breakthrough. And his question is, have the Federal Reserve Bank of Dallas and/or Kansas City researched the labor market trade-offs associated with stimulus focused on green versus brown job creation?
So, not the I'll speak for our research right now. Not the stimulus part per se, but we have done a lot of analysis on the jobs directly and indirectly related to the oil and gas business, and the jobs that could likely be related to wind, solar, other forms of alternative energy. And I guess without going through all the detail of that, again, it would reiterate to me, there'll be plenty of jobs in the energy industry. There will continue to be plenty of jobs in terms of midstream, downstream, upstream parts of the oil and gas business. And for those who are not in the business, extraction, pipelines, and then refineries, petrochemicals, and other areas, and plenty of indirect jobs. But what we've also seen is the big effect on the economy from oil and gas, I would just observe, and we've learned in studying it over the years, is it's not as much the employment impacts as it is the capital expenditure impacts. The oil and gas industry has an impact on Texas and on the country in terms of jobs, but the bigger impact is on capital expenditures. And you will see a drop, and we are seeing this year a meaningful drop in CapEx in the oil business. And that's probably having a bigger effect on the economy and an indirect effect on jobs, even more than the direct effects of employment. And we also think you'll see substantially increased CapEx. Now, stimulus and government subsidies will affect that balance, but I actually am pretty optimistic. However the mix shakes out, there'll be plenty of CapEx and jobs in the economy, but the mix is going to change. But in the short run, there's no doubt we've seen a substantial drop-off this year in CapEx, and that does have a negative effect on the U.S. economy.
Great. Next question is from Zach Boyer at Guggenheim Securities, and his question is, are we seeing some type of relationship, or is a relationship forming between energy prices and employment levels and work-from-home policies?
Yeah, so I would say there are relationships, but they're more coincident, a lot of them, than causal, okay? So people are working from home much more, as we've talked, and we all know. And that's why driving activity, as we've just said, is not where it was a year ago, but it's about 88% of that. And for those who out there say 88% doesn't sound bad, 88% is a dramatic drop, okay? And of course, I don't need to tell you, people are not flying. And so as we get into the spring of 2021, and God willing, we have vaccines, and we get a population that's more broadly inoculated, and there's more mobility and engagement, you're going to see that 88% climb. You're going to see flying eventually climb. And what does it mean? I'll go back to this excess inventory. The more we open up and you see more demand and you see more mobility and engagement, we're going to work off the excess inventory I just talked about faster, and all things being equal, that'll have a positive effect on oil prices. I think some of it's already, that expectation is probably already reflected in the markets, and you're seeing that. But it's a more relationship. You'll see oil prices being firmer, one of the indicators that mobility and engagement are increasing.
A question that just came in from William Simmons at SCF Partners. Are there historical examples of industries going through transformations like the energy industry is expected to go through over the next 20 years? What should companies and investors do to be successful? Does the telecommunications business offer a potential model?
Yeah, so that's a good question, and I would expect that. We know Will Simmons well because he worked with us for 2 years as an intern or assistant to me and to our research staff for 2 years at the Dallas Fed. So nice to hear from you, Will. So yes, of course. Listen, I believe the story of capitalism, over the last 100 years is innovation. And what happens is some businesses are able to adapt and industries are able to adapt. It's not easy, but it means new CapEx, taking new risks, disrupting yourself in some cases. And you will see some businesses actually and in industries diminish and new ones take their place. And it's probably not something to fear. It's part of capitalism. But if you're running a company or a private equity firm or some other type of entity that's going through this, what you have to do is, and this is more with my business person's hat on, you have to keep an open mind, understand where the world is going, and see if it's reasonable for you to be distinctive at where the world is going and change your investment profile and de-emphasize certain things, emphasize new things. And yeah, our industries, you can go through industry by industry, and we're seeing it today, where the way businesses are operating, whether you're in retail, you're in manufacturing, you're in telecommunications, they've had to dramatically restructure. And some are able to do it on their own. Some have needed to merge. Some of it have changed form. But that's the story of capitalism. And I'm confident with the talent in the energy business, and we know many of these folks. We have lots of excellent leadership. They'll figure out a way to make this transition. It won't be without pain, as it always is. But I'm confident that you'll see this industry do that.
Hey, so changing topics slightly, another question that just came in from Bill Gazellum. I hope I got that pronunciation correct. At Teton Capital Management. Given the economic virus concern you noted for the next 3 to 6 months, what fiscal policy changes do you recommend, if any, over this period? Yeah,
so on the one hand, I'll say at the outset, I'm careful not to tell fiscal policymakers or give what they should do. Having said that, our job at the Dallas Fed is to call out what we're seeing and then point out what types of actions could be helpful. So while staying in my lane, let me say what we're seeing. First of all, it's our own observation here that the unemployment benefits are going to run out at some point. In other words, the additional unemployment benefits, and we're starting to see that already. If those do, in fact, the savings from those do run out, you're going to see consumer spending get weaker. And this, for many businesses, not just person-to-person businesses, that'll affect businesses broadly. And that this hasn't felt as much as like a recession for a lot of businesses. It will start to if you don't have some renewal in some form of the fiscal relief, because you've got millions of people that are continuing to make ends meet and spend, based on that fiscal relief, and that will continue as long as we're in the middle of the resurgence of this virus. So that would be the first thing to point out. Second thing would be many states and cities across the country, including Texas, are struggling now with a fiscal hole created from lack of revenues in the second quarter. And I think this is true of a lot of mayors and governors that I talk to, and they're going to need to make cutbacks if there isn't fiscal relief to cities and states. So that's another area. And so I guess I'll stop at those two. Those are the two most important ones that come to mind.
Okay, going back to some energy issues, a question from Alexander Labelle. During World War II, the Fed was prepared and used its powers to assure at all times an ample supply of funds for financing the war effort. Will the Fed take this same approach with renewable energy and the climate crisis in general to assure that there is an ample supply of funding and financing for these types of projects? Does the Fed see more businesses adopting renewable energy? And how does the Fed identify the climate crisis as a risk to the economy? So kind of a three-part question.
Yeah, so to be clear, the Fed is trying to keep financial conditions robust enough that businesses, large and small, have access to capital. That is one thing that we're working on intensively right now, and we'll continue to. We don't choose industries and we don't pick industries. That's the role of elected officials and the executive branch, who are elected by the voters. And so as it stands now, I can tell you at the Fed, we look at a lot of these issues by industry, particularly what's going on in the energy industry, renewable industry, and a whole bunch of other sectors. But right now, our mandate is to address financial conditions broadly, including making sure that healthy businesses have access to bank loans, as well as making sure businesses have access to the public markets. But right now, based on our mandate is not, other than to talk about and do analysis on different industries, we don't actually apply monetary policy to affect one industry versus another.
Next question, one that just came in from Robert Sakowitz. The question is, with the Asian nations' economies improving at a faster rate than the US and Europe, isn't that a positive impact for our Texas energy exports? If so, to what amount?
Bob, the answer is certainly yes. The price of oil would be lower if it weren't for the fact that the rest of the world, if the rest of the world wasn't doing as well as it is in combating the virus, particularly Asia, the price of oil would be lower. So we're benefiting from the resurgence of business in China, again, Taiwan, South Korea, Japan, and it's creating more business opportunity, not only in the oil sector, but I'd say in the U.S. economy broadly.
Another question that just came in from Andrew Bush. Working off excesses reflects a belief that we will return from a work-from-home stance. All the surveys show that workers like working from home and that productivity has remained high. What happens if your assumption is incorrect? What would the implications be for commercial real estate?
Yeah, so to your point, Andrew, and I think that's an excellent point, we don't know, and I'd be the first to say, I know there will be some increase in mobility engagement, people going to the office, people going to shop in person, but we don't know how much of these trends will reverse. So my guess is you're going to have in the future a much higher percentage of the workforce and businesses deciding their workers can work from home and they actually don't need to come in. Or maybe they need to come in 2 days a week, but they can work from home the other 3 days. And you're going to see much more of that. And talking to CEOs around the country, there's no doubt that trend is going to happen. And you will see people who used to live and die by going shopping in person have now been forced to use online services, and they actually find, to their amazement, they like it better to buy a car or to go shopping for other items. So some of these changes in the pandemic will reverse and some won't. And so what are the implications for energy? All things being equal, that would suggest less energy usage, less travel than we're used to in the past at the same level of GDP growth. And there's no doubt that we're going to have to learn as we go what changes are temporary, what changes are more persistent and permanent, and what are the implications. And back to, you asked about commercial real estate, and I've spent a lot of time talking to businesses and commercial real estate owners. There's no question that some cities and states, commercial real estate, some of these buildings will not get back to full occupancy. They're going to need to be repurposed. The landlords are going to need to find other options. And I would go a step further. Retail space. We've known for years, pre-pandemic, that the U.S. is overstored, significantly overstored, more than other countries. In other words, retail per capita has been dramatically higher than other countries. So we knew there was going to be a restructuring coming. The pandemic has accelerated that. So you're going to see many malls, other real estate properties need to be repurposed for another purpose. And so, yeah, there'll be a whole range of activities that happens. I think financial institutions, in terms of reserving on loans, are well prepared for it. And I think a lot of businesses are already making plans, and real estate owners are making plans on how to deal with that transition. But there's no question that's going to happen.
Changing gears a little bit, here's a question from Ken Becker. How do we encourage the education sector to do a better job of preparing, be it improved skill sets, our workforce pipeline with more certifications and less four-year degrees? Also to the cost of education. How do we make this transition work?
So that's one thing, as people here know, we spent an enormous amount of time talking about at the Dallas Fed and talking to community leaders about, because we think we need to dramatically beef up skills training. So then how do you do it? And there are already some great role models for this. There are some excellent junior college presidents in this country that already go into their communities, interview businesses, backward integrate in their curriculum, and a lot of the staffing, the faculty, comes from the businesses in the community, automotive technicians, registered nurses, others, and a lot of the businesses in their communities pay for this. This is happening at high schools, and a lot of workforce development boards in cities and states are focused on this. The problem is it's uneven. So how do we incentivize it? One is to call it out, talk about it, and I think you're going to need to see a much more emphasis from business leaders, government leaders, state, local, and to some extent federal, really focus on this and have persistent and deliberate emphasis on staying with us. And I'm confident we can do it. The reason it's so challenging, by the way, is worker mobility is historically low. So it's got to be done by city and by state. If you have great workforce development, 1,000 miles from here, it's not typically terribly helpful, because a worker is not going to move 1,000 miles or travel to do workforce development, and it's not easy to do a lot of this skill training remotely. A lot of time you got to go in person. So this has got to be done across the United States, and I think we need a national initiative and across the country to really beef this up. And I guess I forget the other part of your question, but maybe that covers it. And I think the starter is to talk about it. That's why, as Mark Wynn knows, every talk I give, we never have one without mentioning this, because we think it is so critical. And oh, by the way, it doesn't take much government money. A lot of this is going to be funded and is being funded by private business. This is one of these things, public-private partnership is very effective.
Got a few questions on monetary policy, if that's okay. So this one is from Mark Schumacher at Third Day Capital Management. I would be interested in each of your response to this question on the adoption of forward guidance as a key policy tool appears to have had limited, if any, positive influence on either inflation or economic activity in Japan and Europe.
Yeah.
Do you think there is something in particular about these economies that rendered forward guidance less effective than it will prove to be in the United States, or do you think forward guidance as a tool is inherently ineffective after some initial but brief period?
All right. So just for the broad audience, let me just define what forward guidance is. Fed has a number of tools. One is interest rates that we set. Another is we can do bond purchases as we are. And another tool we have is quote unquote forward guidance, which means we can say today what we're going to be doing in the future and make commitments about what we're going to do with rates. So for example, in September meeting, the FOMC made a commitment to keeping rates where they are until we've reached full employment and we've reached our inflation goals. That'd be an example of forward guidance. Okay, so why does it appear that it may not have gotten inflation to 2% in Japan and other countries, and will it work here? And here's the problem. Forward guidance, the same as low rates, in our opinion at the Dallas Fed, it helps, no question, firm inflation. It helps by, though, improving the cyclical elements of inflation. Tighter job market, more business confidence, probably more pressure on wages. Here's the issue. There's a powerful counterforce the other way, which is if you're a business and your wages need to be higher because you have such a tight labor force, then the question is, are you able to pass on those prices to customers? And because of technology and technology-enabled disruption, which is a structural trend, a lot of businesses, when they have wage pressure, are more likely to see margin erosion and do not have pricing power. And that's a powerful structural force the other way. Monetary policy is pretty potent on fueling the cyclical forces, but if you've got a counterforce in terms of technology-enabled disruption, which I think is intensifying, you still may see muted inflation. So it's not that monetary policy isn't having an impact. It tells me at least that some of these structural forces are very powerful, and that's why you're seeing more muted inflation.
I think we just have time for one more question.
Okay.
And this one comes from Andrew Wigren at Fidelity Investments. Does or would the Fed contemplate ESG factors in its corporate bond asset purchases? If so, how would it determine good versus bad ESG firms? And I guess that's environmentally sustainable growth.
Yes. And so I would just tell you flatly, based on our current mandate, and I'll echo what I said earlier, where we don't pick industries, and you'll notice even in the bond buying we've been doing, we are very careful to buy broadly across an index. We've been criticized for that, by the way, because we're buying bonds of some companies that people say, why are you buying their bonds? They don't need your help. But we're very careful not to choose industries. So I would say sort of our mandate would need to be adjusted. But for the moment, we don't delve into sector by sector. That's a judgment for elected officials and for Congress.
Okay. Well, I think we're close to time. So thank you, Rob.
Thank you. And I again want to thank everyone for attending this conference. I think we've got a great day planned. And the energy sector is critical to our country. It's critical to the world. It's going through significant transition and restructuring. And so I think this conference probably couldn't come at a better time to try to grapple with these issues. So thank you for being here today.